morning. This is Horizon's Middle East and Africa. Our top stories this morning. Nasdaq 100 futures on a tear as strong earnings from Amazon and Apple lift sentiment after a brief pause in the global stock rally. Oil heading towards its third monthly drop on concerns of a global supply glut as OPEC Plus plans to hike output again this weekend. Plus, Chinese President Xi Jinping warns against breaking supply chains in his first public remarks after the pivotal meeting with his U.S. counterpart Donald Trump. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Barsetchi in Dubai. A bit of a pullback yesterday for some of these global markets. Wall Street drifting lower, Nasdaq down 1.5%. A perfect storm, you could say. Concerns about capex spending coming through from Meta. That stock significantly down in trading yesterday. A more hawkish Fed, and perhaps the market a bit underwhelmed by the meeting that took place between President Trump and President Xi. All of that set the tone yesterday, but things are looking up this morning. And also, we are really focusing on some of these stocks' earnings that came through overnight. Apple and Amazon. We're going to be talking more about that on the show, but very strong Amazon on AWS and very strong Apple on the iPhone 17 sales. So that's lifting sentiment. As you can see, Nasdaq up 1.2% this morning. So better tone than yesterday for sure. Brent also in focus, trading just shy of $65 as we head into another OPEC Plus decision this weekend. They are likely to return 137,000 barrels to the market once again, but the market is really much focusing on the potential overhang of supply that's to come in the coming months. So a big theme. Again, we'll discuss that on the show. And then Euro, we had an ECB meeting yesterday, keeping the course steady. But what you did get is an ECB meeting where they're not hinting of any future interest rate movements in the coming months. At the same time, we've got a more hawkish Fed. That's given the dollar a bit of a lift. And so the reaction in Euro is one of weakness. 115.70 is where we are right now. So back to around 115 handle. Levels not seen since July of this year. And switching over, one thing that I do want to show you is the Bloomberg Global Trade Uncertainty Index. And you'll see from this that after the Trump-Xi summit, we're basically back to levels we haven't been at since the beginning of the year. So investors increasingly brushing off some of those concerns around tariffs, around trade uncertainty. And I will say, just sort of getting used to it at this point. So interesting chart and perspective there on global trade policy uncertainty sentiment. All right, let's also check in on how markets in Asia are faring with Winnie Su in Hong Kong. Winnie, I've been talking about a more upbeat start to the session for U.S. Wall Street futures. How has it been in Asia today?
Yeah, morning, Jumana. So you can see that actually, investors are still really digesting whether it's earnings or central bank decisions or just the Trump's Asia tour that just wrapped up. And here on the board, you can see that the MSCI Asia is just slightly up with 0.2% to the upside. And it's really being driven by gains in the technology shares. Specifically, you can see that the Japanese stocks Nikkei 225 up slightly less than 2%. But I really wanted to point to you that the Nikkei 225 actually is now headed for its biggest monthly gain in about 3 decades. So you can see that tech optimism has been really helping the gauge to perform. And we are seeing just now a bit of strength in the Japanese yen. But remember, it's coming off quite a big weakness after the Bank of Japan kept its rates steady yesterday. And the yen actually weakened to a 8-month low yesterday. Now we flip the board and look at what is driving the benchmark slightly lower. That is the Chinese stocks here. You can see across major gauges, they are all in the red. And here the MSCI China down more than 1%. Now we are at the end of the month. So MSCI China actually is one of the worst performing gauges globally in October. And that was really driven by how the expectations were very high into these meetings, whether it's the plenum or the U.S.-China meeting that wrapped up yesterday. So a bit of a profit take there and a little underwhelming when it comes to the details. But again, we still have President Xi at the APEC CEO meeting, so we are awaiting further details to see if there's going to be further developments. Back to you, Jomana.
Thank you, Winnie. Well, most certainly the big outperformer this week was the Nikkei. That index up more than 5.9% in the last 5 days. Well, let's talk about tech again. Apple is predicting a major sales surge during the holiday season off the back of its latest iPhones, helping assure investors that its hold on consumers remains strong. Bloomberg's Ed Ludlow has more.
In the holiday quarter, Apple said revenue growth would be between 10% and 12%, but that sets the iPhone maker up for its best ever quarter. And the acceleration largely attributable to iPhone 17 generation. You have to remember that in the quarter they just reported, there's only about 8 days of real sales data because the iPhone 17 went on sale September 19th. The quarter ended September 27th. Greater China was a really interesting one. It was a pretty significant miss in the quarter gone, but the way that Tim Cook explained it was supply constraints. They did not have the supply to meet demand in that market. Note that the iPhone 17 Air wasn't available in Greater China because of regulatory restriction on eSIM. But they do expect in the fiscal first quarter Greater China to return to growth simply on the strength of iPhone 17. They said it's had a great reception there. And then other than that, the forward-looking stuff was a commitment to invest in AI, but that's largely in the form of OPEC reflected through R&D, not some massive capital expenditure commitment. And then there's the impact of tariffs. They do see it rising from an impact of about $1.1 billion to $1.4 billion in the period. But executives seem very comfortable with that. They seem to have a good understanding of the level of tariff, particularly as it relates to China. Overall, though, a lot of momentum, and it was all about this latest generation of iPhone. They talked a very strong game with also some emphasis on the services business. This is Ed Ludlow for Bloomberg News in San Francisco.
And Amazon shares soared in late trade after its cloud unit posted the strongest growth rate in almost 3 years. Third quarter revenue jumped 20% on year to $33 billion. Investor expectations for the cloud business were relatively low after the company had warned of constraints in getting new data centers online.
AWS is gaining momentum. Customers want to be running their core and AI workloads in AWS, given its stronger functionality, security, and operational performance. And the scale I see in front of us gives me significant confidence in what lies ahead.
Well, joining us now is TenCap co-founder and lead portfolio manager Jun Bei Liu. Jun Bei, it's really good to catch up with you. I really feel like in the last 24 hours, the market has been searching for a narrative. We had a perhaps slightly more hawkish Feds come through, which was, shock number one yesterday. You had the huge capex spend being announced by Meta. Again, another negative catalyst for the market. And then also investors seem to be underwhelmed by the summit that took place between President Trump and President Xi. Which one of those narratives do you think is going to determine the direction of travel in the coming weeks?
Look, at the direction of travel is going to be recovery for what has happened in the last few days. So really, investors, exactly as you said, investors has bid up the market significantly into those events. And so in what you call it the buy the rumor, sell the facts. So when it happens, investors should take these opportunities to take some profits off the table. However, if you look at the earnings so far, and then if you look at what is really driving the market growth, we think that will continue to see the market to grind higher. First of all, corporate earnings still pretty strong. You've got the financials, the banks are doing incredibly well. The investment banks talk about how many, how much activity that is to come in 2026. You've got a consumer holding together somewhat, and then you've got the AI investment is keeping up very strong. So I think all of these thematic will continue to see investors putting money back into the market. And remember, November and December are the two stronger months seasonally. So we will see this center rally into the next couple of months.
One thing that stood out to me from Amazon's earnings is that their own capex expenditures rose 61% in the quarter. I mean, again, these companies are really undertaking mega spending capex plans. And I wonder which camp you're in, whether you're concerned that there's too much money being poured into AI infrastructure, or whether you're in the camp of others in the industry who believe that actually demand is surpassing supply, and it's actually incumbent on a lot of these companies to keep spending to keep up with that demand in future years. There's no risk of not generating that return of investment here.
Yeah, look, to be honest, I think the risk is there, especially the more you spend, the higher the valuation goes, especially for physical infrastructure like data center. And many of them, in particular, at the most risky areas where you see, huge amount of spend. You don't have any contracts until many years into the future. And then it's difficult to ascertain for these particular capex, whether you get proper return. But for those hyperscalers, we are seeing incredible amount of demand. They just couldn't build fast enough at this stage. So look, we do think that with the demand for AI infrastructure is there, and at least for the time being, we just couldn't resolve some of the bottleneck. Hence why there are more and more investment into those. We think that the AI trend is not a bubble like many suggest. That we think it's got real applications. It's moving to agentic format now. We do think that's now going to drive the next level integration or adoption, if you like. Every company we speak to is talking about how they're using it, integrating it, and then holistically changing strategically where their business plan is going for, especially some of the large financial firms like Goldman Sachs and the like. So look, we think this is, it is one of the most fascinating space, and we are very early days in those trends.
Okay. Are you changing any of your portfolio allocations based on the Fed decision the other day and the fact that December is not a done deal, and likely also they're not going to be able to continue with the full amount of rate cuts that are priced in for next year?
Yeah, look, we don't think so. We do believe the minor adjustment will be that some of the property space has done quite well, and hence that there will be a bit of softness to come through. I think net you still have more rate cut to come through, and that will continue to support the valuation for the market, and then for some of the lower interest rate beneficiaries, whether it's consumer or housing and the like. But I don't think that narrative really changed directionally where it's going. It's just going to put a bit of volatility for some sectors, which is entirely depends on the lower interest rate, such as property trust.
Yeah. And Jun Bei, I want to round up asking you about, TenCap announcing the launch of a long-short ETF in Australia. Why is the timing right for this?
Yeah, we just increasingly market is becoming more and more complex, and investors don't have access to funds. The long short funds like our funds can benefit from rising share prices and falling share prices. So by having an active ETF, it gives the investor direct exposure to that kind of product, and timing is perfect because there's lots of opportunity in the marketplace.
All right. Well, good luck with the launch. Jun Bei Liu, TenCap co-founder and lead portfolio manager. Thank you so much for joining us. Well, coming up, OPEC Plus set to hike supply again this weekend as global glut concerns gain grounds. We discuss the oil market and the alliance next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Oil is heading for a third monthly loss on concerns of a global glut. That's as OPEC Plus is expected to back a further output hike when the alliance meets this weekend. For more, we're joined by Clara Ferreira Marquez, who leads our energy coverage. Clara, just talk us through what we should be expecting out of OPEC Plus this weekend. They've already put back a ton of supply to the market this year, 2.2 million barrels. Will they be more cautious in the coming months?
What we are expecting, the base case for this weekend is that we will continue to see supply added to the market. But the interesting thing is we are headed into this weekend with investors weighing up a whole range of factors. So, for example, you have the US sanctions on Rosneft and Lukoil, so Russia's two largest producers. If that supply does come offline, it would unquestionably tighten the market. You're also looking at Russia, of course, in no mood to see prices go any lower. However, if you look at the market today, what it's telling us is that really it's the glut that is concerning investors more than anything else. So questions around enforcement will probably be what's balancing out some of the sanctions action.
Yeah, it's interesting. We heard from Total Energy's CEO yesterday, and he was saying that oil markets are actually underestimating the impact of recent sanctions on Russia, which actually have started to affect flows. And we've heard of some of those Indian refiners pausing purchases of Russian oil. What is actually happening in physical trading right now? What are you seeing?
So it's a little difficult to tell because these sanctions only come into effect on November 21st, right? So we're in a wind down period now. What we have seen is the Indians pretty much immediately, the large Indian refiners, companies like Reliance pretty much immediately stopping purchases, but they have left themselves a little bit of room for maneuver. They could, for example, take non-sanctioned Russian oil. So that would be companies that are not so good, Neftegas, Gazprom Neft, Lukoil, and Rosneft. The big question here is how quickly the market can adapt. We saw it adapt after 2022, how much transshipment can take place. India tends to be a lot more cautious. India tends to be a lot more cautious than China. So how much of that will continue to flow to India? Question mark. How much more could China take? Another big question mark.
Absolutely. Clara Ferrer-Marquez, who leads our energy coverage, thank you so much for the preview. And we'll be continuing the energy conversation at ADIPEC next week with newsmakers, including the CEOs of Eni, Exxon, and ADNOC's upstream business. It's going to be busy once again. This is Bloomberg.
We are transferring enormous amounts of wealth overseas, but specifically to China, directly and through countries that they transship through. So we need substantial tariffs to get that back in the direction of balance.
Robert Lighthizer, President Trump's former trade representative, speaking to Bloomberg there. Well, Chinese President Xi Jinping is warning against breaking supply chains in his first public remarks after the pivotal meeting with his U.S. counterpart Donald Trump. Trump described that meeting as, quote, truly great. But the one-year trade agreement is likely to only stabilize relations between the world's two largest economies rather than resolve fundamental differences, with both sides buying time to further reduce dependence on each other in strategic areas. Bloomberg's Yvonne Mann is in the South Korean city of Gwangju. Yvonne, look, you can see the market reaction the last 24 hours, a bit underwhelmed. And I guess the takeaway here is perhaps this is less of a structural framework that's been agreed between the two sides and more of a truce.
Yeah, I think from the guests that we've talked to, their response so far is that it's not a significant turning point in the relationship between U.S. and China, but we have seen both sides commit to at least bringing down the temperature for at least another year, right? That one-year truce certainly is longer than the usual 90 days that we've seen these sort of truces last. So, lots of questions really of what happens after that 1 year. But for now, people say, look, it is a truce, not really a treaty. The fact that there was no actually signed agreement that came through with these talks suggests that maybe it's also at risk of falling apart as well. We saw what happened just a few weeks ago when the U.S. came through with these sort of rollout of these sort of stricter export curbs around subsidiaries of blacklisted Chinese firms. That's when we saw China ramp up with export curbs around rare earths. So at least for now, we saw good optics. The tone was very positive. And of course, we are seeing here at least some détente. The question is, of course, how long it's going to last. But today, Donald Trump is back in the White House. We have President Xi in the spotlight here today. We're expected to hear in a speech later on addressing the 21 leaders of APEC. We did get a snippet, as you mentioned, in that speech. And really becoming the message in that speech was China is a defender of the global trading system at a time when America is pushing forward in this kind of America First policy.
Yeah, I'm not sure how other countries in Asia would feel about that because of the sheer amount of Chinese goods that have started coming into those countries. We've spoken about this on the show many times as well. China rerouting some of the trade flows. But anyway, I digress. I want to talk about U.S. and China and sort of what we should be watching out for next, Yvonne. Like, what is the next milestone? President Trump said yesterday that he may be traveling to China in April. Do we have to wait that long to get an update on how this truce is going?
I think so. I think from what we heard from the likes of Scott Bessent, from Jameson Greer speaking I believe in the local, the U.S. networks after they arrived back in the U.S., saying that, look, it looks like we can actually extend these trade truces after a year. So they're looking at it as a 12-month basis here right now. I think the key thing in the light of all this the next few months is really kind of watching how these sort of measures and what was agreed upon in South Korea are going to be enforced, right? Are we actually going to see China resuming purchases of soybeans? Scott Bessent told Fox Business overnight that he expects 25 million metric tons of soybeans being bought by China annually in the next 3 years. So also when it came to some of these export curbs, right? When it comes to rare earths, when it comes to the U.S. side of things, are we likely to see cracks in these sort of suspensions and freezes? Those are going to be key signs here of whether we're going to see more escalation or actually more of a de-escalation as well. So beyond just sort of the tariff headlines, which certainly we have brought down the temperature on that, where China now is dealing with effectively 47% when it comes to tariffs. Now, fentanyl tariffs are down to 10%. U.S. also suspending those reciprocal tariffs on China as well. But when you talk about what came out of all this right now, it seems like the sweeping use of export curbs on critical minerals was at least able to put a cap on export curbs in the U.S. So there have been experts that tell us, China, as they continue to develop and become this sort of techno-nationalist sort of industrial superpower, they might still be using these sort of key negotiating tools, these key sort of ways of changing the dynamics of global trade to gain some more economic leverage. So that certainly is key things to watch here. But for now, I think people say at least we're seeing some stability for the next few months.
Yeah. And also, let's see what happens with those Blackwell chips as well, a key omitted part of the discussion yesterday. Yvonne Mann, thank you so much for the reporting this week at APEC. Okay, quick look at equity futures. Things are looking up after pullback for Wall Street yesterday. Focus on Amazon and Apple, very strong after hours performance. Look at NASDAQ, up 1.2% as we head into the European session. European markets, a little bit of red there, down 0.1%. But coming up, we are going to be speaking more about oil as we head into a very important OPEC Plus decision with Keisuke Sadamori, IEA Energy Markets and Security Director. That is happening next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. NASDAQ 100 futures on a tear as strong earnings from Amazon and Apple lift sentiment after a brief pause in the global stock rally. Oil heading towards its third monthly drop on concerns of a global supply glut as OPEC Plus plans to hike output again this weekend. Plus, Chinese President Xi Jinping warns against breaking supply chains in his first public remarks after the pivotal meeting with his U.S. counterpart, Donald Trump. Well, it's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace back here in Dubai after 4 days in Riyadh. Good to be back over here. Checking in on markets, and what you're seeing today is futures actually are leaning towards the green. We had a pullback for Wall Street yesterday. The tech sector getting hit. Meta, one of the names that underperformed. The market a bit spooked by the sheer extent of their capex spending plans. But then overnight, we had very positive results from Amazon, Apple. Amazon driven by its AWS business. Its cloud business continues to perform strongly. Apple driven by sales of its iPhone 17. So that set the tone this morning. You've got the NASDAQ futures up 1.2%. For the week, though, I should say, despite yesterday, we're still up more than 2.5% for NASDAQ. So that's the picture over there. Heading into a weekend where oil is going to be front and center. Yvonne's standing by with the guests. They're going to be talking about this. But there is an OPEC Plus meeting coming up this weekend. They're likely to put more barrels back to the market. And, of course, the geopolitical backdrop, an interesting one with the U.S. administration applying sanctions on those two Russian firms. terms. So that's going to be in focus in the next couple of days. And then euro, you can see back with the 115 handle. We had an ECB meeting yesterday, no fireworks, nothing really was expected to come out of it. But you have to think about it in the context of the Fed meeting the day before, where Fed Chair Jerome Powell sounded slightly more hawkish, which means you got a bid for the dollar, some downside pressure on the euro. That was a very popular position, long euro, in the the last couple of months. And so you can see a bit of a pullback there, 115.70. And because we've been spending so much of this week talking about that Trump-Xi summit, I will just point out we have this Bloomberg Global Trade Policy Uncertainty Index, and you can see that it's sort of been sliding lower and lower and lower. We had a brief uptick into and around that summit, but essentially we're back to levels not seen since January of this year, which tells you that investors are becoming a lot more immune to some of the trade headlines that have been swirling around. Very interesting, that one. Okay, let's also check in on how markets in Asia are faring with Winnie Su in Hong Kong. Winnie, a bit of a mixed bag today in terms of the handover.
Yeah, exactly. That U.S. tech optimism is definitely helping towards the upside here for Asia stocks. But you can see it's just a bit of a modest gain here. And investors are still really digesting what's been going on over the past few sessions in Asia. We've had a really busy week, whether it's for earnings or Trump's visit and also the central bank decisions. So, wrapping up the week here, but we are seeing quite some strength when it comes to Japanese stocks, specifically the Nikkei 225, also helped by the earnings optimism, whether it's domestically or from these U.S. names, Apple and Amazon that you mentioned. Here, the Japanese yen slightly strengthening, but also still around that 154 level against the dollar. Remember, the Japanese yen actually weakened to an 8-month low yesterday after the Bank of Japan kept its rates steady. Now we flip the board and take a look at what's going on in Chinese markets, because Chinese stocks actually today are the worst performers in the region. Here, the key major gauges are all in the red, and specifically for the MSCI China, down more than 8%. Obviously, it was some positive tone out of the meeting between Trump and Xi, but investors find the details a bit underwhelming and still some concerns around how far this trade truce can go. And domestically, we've also got that weak factory activity numbers still pointing to the weakness in the economy. And here, the BYD actually shares dropped over 2% after some disappointing earnings. So a bit of a cautious mood here in China. Back to you, Jomana.
Winnie, thank you so much. Winnie Su in Hong Kong. Now, key members of OPEC Plus are meeting on Sunday to determine production policy for December. The group is expected to announce another small output hike, which may amplify concerns of a global supply glut. Let's cross over to Guangzhou now, where Bloomberg's Yvonne Mann joins us from the APEC summit with a guest. Yvonne.
Yep, Jumana, we are speaking with Keisuke Sadamori here from the IEA. He is the Director for Energy Markets and Security. So the perfect guest to talk about the state of oil and energy markets here in the face of all these political instability. Keisuke, it's great to have you here in Gyeongju with us. You mentioned more about this wave of LNG supply that's coming into the market, but this is coming at a time when it seems like energy security concerns are driving a lot of the investment into this market. How do you see global gas flows evolving in the face of all this?
Well, thank you. First of all, since the Russia's Ukraine invasion in 2022, the global natural gas market went through a very difficult and a volatile period. And the tightness still continues, and we expect to see rather slow demand growth in 2025. But this will change from next year, as we expect, as you point out, that our gas market report 2025 expects a big wave of LNG capacity coming online toward 2030, around 300 BCM. And this will be a relief in terms of the energy security and affordability to the global markets, in particular for the importers of this region, who are quite rather price sensitive.
Yeah, as you mentioned, Asia is still the center of that gas demand growth, right? And as you start to see some of these LNG and pipeline deals being tools in foreign policy in some ways, do you think that for these economies, is it more about economics and supply and demand, or is it really a sort of strategic hedge against geopolitical concerns?
Of course, the well-functioning market will be a very important factor in terms of ensuring the energy supply security. Having said that, as you point out, that there's an increasing tensions in geopolitics and also uncertainty with respect to the various kind of trade policies. So there needs to be enhanced international cooperation to ensure that all countries can enjoy supply security and affordability going forward.
The U.S. seems to be on track to overtake the likes of Qatar as the world's largest LNG exporter now. What are the global implications for this sort of dominance, do you think?
Well, the U.S., in particular, for instance, this year, we saw a massive FIDs, final investment decisions in the U.S. alone. Up to date, this year, we saw the 80 BCM of LNG projects, the FID in the U.S. alone, which is the record-making number. So this will somewhat solidify the U.S. The position as the largest the LNG exporter going forward, and this will be good news for the importers, in particular in this region.
Yeah, well, we saw this big deal signed in Japan this week too, between the U.S. and Japan on LNG. Does it mean that we're entering into a bit of an era where gas markets are just as politically charged as oil markets can be?
Well, previously we considered that the natural gas sources are quite diverse, not concentrated too much in the Middle East. But with the Russian crisis, countries were made aware that the diverse the supply sources and the flexible markets is even more important in this the very difficult political environment.
We have an OPEC meeting. We're talking about that. Your oil report this month really talked about the weak demand growth out there, the rising supply. And the market's been dealing with this oversupply, it seems. When it comes to sanctions, you mentioned U.S. implemented new sanctions on Russia of late.
Yes.
To what extent do you think that this is really going to impact big players like China and India and really reducing their reliance on Russian crude?
Well, that's a big question at this moment. And as you point out, that we are seeing the very robust, strong supply growth, both from OPEC Plus, as they're unwinding the production cuts, and also the no outside of OPEC Plus, while we see the weaker, slower demand, in particular from China. So in that respect, this is a very well supplied market. On the other hand, but we still continue to see what would happen in the political area. And you talk about this, the U.S. sanctions, and we need to see how effective that would be implemented in order to see the real impact to the global markets.
Will implementation be the toughest, or enforcement of these sanctions?
Enforcement, yes.
Yeah. How do we? What metrics do you look at to really kind of gauge where that enforcement is? And really,
it's rather difficult, quite diverse elements. But when we consider the Russian exports, I mean, it's basically the India and China who are the major buyers of the barrels. So we need to see how the buyers in China and India, in particular India, will be impacted with the U.S. sanctions.
Okay. Another kind of a development that came out this week was with U.S. and China trade talks that China was suspending these new export curbs around rare earths. It seems like the message is clear that China is going to be using these critical minerals as economic weapons in a trade war. For major developing nations out there, at least we have some time now to at least respond in some ways. How are these nations going to deal with Beijing's dominance in this sort of market now?
Yeah, IEA released the first comprehensive report on critical mineral issues back in 2021. And since then, we have been focusing on this problem, pointing out the possible very fast increase in demand with the progress in low-carbon technologies, while geographical concentration on the supply side, both in production and refining. So the Chinese suspension of the export control of the rare earth elements, that could be good news, but there's absolutely no room for complacency. So all countries around the world need to work on resilient and diverse supply chains.
Do you see more new alliances emerging from all of this?
I think that all countries, in particular countries with the substantial amount of resources like Canada, Australia, they have been kind of trying to take advantage of their resources resources. But of course, there are various issues with the costs and also the environmental impacts. So the countries around the world need to continue to work on this issue.
Keisuke, thank you so much. Keisuke Sadamori there, joining us from the IEA, Director of Energy Markets and Security, here at the sidelines of the Leader Summit here at APEC. Jumana, I'll send it back to you guys.
Brilliant. Yeah. And wide-ranging conversation. So interesting what he had to say about both LNG and also oil to watch out for in the coming months. Thank you, Yvonne, for bringing us that interview. And on the subject of oil, stay tuned for our coverage. We're going to be continuing the energy conversation at ADIPEC next week with newsmakers, including the CEOs of EQT, Sandbox AQ, Exxon, and ADNOC's upstream business. Now, oil giant Shell has beaten estimates on profits and maintained share buybacks while paying down debt, showing its resilience to weaker oil prices. The third quarter performance was helped by stronger oil and gas trading, a vital part of the business that struggled earlier in the year amid geopolitical volatility. Nissan has warned it expects a $1.8 billion operating loss this year as it pushes ahead with a cost-cutting turnaround plan. The outlook is the Japanese carmaker's first for the fiscal year ending next March, after previously withholding guidance. While Nissan did trim its loss estimate for the second quarter, Bloomberg Intelligence says this is due more to one-time costs. And BYD posted a 33% slump in profit as the Chinese EV giant struggles with cutthroat domestic competition impacting its sales outlook. Overall revenue fell, missing analyst estimates. Shrinking gross margins highlight the pressure from a prolonged price war. BYD's stalling sales saw it lose its title as China's best-selling automaker in September. And Tesla shares fell after the 10th recall of Cybertrucks in less than 2 years. The latest affects over 6,000 units of the electric pickup. It stems from a potential issue with an off-road light bar accessory, which could detach and increase the risk of a collision. The EV giant says it is not aware of any crashes, injuries, or deaths related to the issue. And coming up, Tanzanian authorities have lifted an internet blackout imposed after a controversial general election. More next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Tanzanian authorities have lifted an internet blackout that was imposed to try and quell riots, which broke out after presidential and parliamentary elections. President Samia Suluhu Hassan is seeking a second term in the election and is almost guaranteed to win because her main opponent was barred from running. Our chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. We were covering this over the last couple of days, but seems like things have taken a turn for the worse. What is the latest, Jen?
That's right, Jumana. It's been quite an evolving situation over the past few months, but especially over the past few days since that election on Wednesday. What we know, as you were just mentioning there had been a curfew that was imposed in Dar es Salaam, which is the economic hub of Tanzania. That's been lifted. The internet blackout reportedly has also been lifted, and that's because we saw a number of protesters that had taken to the streets after the vote had started, just in their frustration about the current situation. We had some reports, as you were just showing there with some of those pictures, there were reports of tear gas that had been flying as well. Also, a number of protesters who were clashing with police. And we should remember that this is not just happening over the past few days. A lot of this frustration stems from months back, where a lot of Gen Z and young people are frustrated with the current ruling party that's been in power for more than 5 decades. And some of the concern has come from international groups, including Amnesty International, which actually went into a report and said allegedly that the authorities in Tanzania had been silencing dissent, committing systemic human rights abuses ahead of the polls. And so there has been a lot of built-up tension. At this point in time, we're still waiting to see what the final results are from the polls, but there's a number of multinational companies that are operating here in Tanzania. At this point, we know there have even been some Emirates flights that have been halted just as we assess the situation. So it definitely is evolving, and Tanzania is a critical nation for a number of multinationals, so something we're watching quite closely here.
And Jen, is it too early to determine whether there are going to be any financial or economic implications of this continued unrest?
You can only imagine, Jumana, that a number of multinationals are watching this closely. I was mentioning Emirates has already reportedly halted some of the flights into Dar es Salaam, but a number of companies operate here in the country. There's also there's reportedly an LNG project that President Hassan is supposed to be overseeing in her next term. That's $42 billion gas facility. That is something that these companies are going to be watching very closely. Not just that, she's made commitments for a number of ports and rails, and Dar is meant to be a very critical port in terms of East Africa and Southern Africa. Not only that, there's of course potential hits to tourism numbers. There's Zanzibar in Tanzania, but then also Mount Kilimanjaro, and so many multinational companies that we have been speaking to are watching closely for this situation, especially because I think I was mentioning this the other day. Copper is very, this part of the world is very critical for copper producers in terms of exports. And so any sort of damage or any sort of widespread damage could have implications to sectors just outside of some of the ones that we were just mentioning there.
Yeah. Very good flag as copper continues to trade very close to the record highs. Jennifer Zabazaja, our chief Africa correspondent in Johannesburg. And for more stories like this around the continent, be sure to subscribe to the Next Africa newsletter on the terminal and our website. You can now also get the latest news from our continent on our weekly podcast, available on Apple, Spotify, and wherever you get your podcasts. Coming up, Saudi Arabia says it now expects to decide on changes to foreign stock ownership caps next year. We'll discuss what is driving the delay next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersace in Dubai. Well, Saudi Arabia says it expects to decide next year whether foreigners can hold majority stakes in local companies. That decision is against expectations of a faster rollout of market reforms and led to the biggest sell-off in the country's stocks in a week. Bloomberg's Laura Gardner-Cuesta joins us now. I remember when we reported on this story about a month ago, we saw a lot of excitement around the potential change in these foreign ownership laws. It seems as though now they're delaying the decision.
Yeah, so essentially what they said yesterday is they gave us a different timeline to what they gave us back in September. So in September, the CMA said we might see a review of this ownership cap by the end of the year. What they've said now is that they will only look into it as of next year. So we really don't know at this point when that cap might.
And do we understand the implications this could have on ownership of Saudi stocks or the involvement in Saudi stocks?
So currently they're capped at 49%, so foreigners cannot have a majority ownership of Saudi stocks. What we saw in September when they announced that they might review this and allow majority foreign ownership was like the expectation of huge inflows and a lot of excitement around Saudi stocks. Like you said, the stock exchange has been one of the worst performers this year in emerging markets, and this really lifted the stock exchange. But now we're seeing that they're sort of delaying that timeline a bit, and they said they're going to sequence it, right? So they're still working on lifting some caps, so they're going to review. There's a consultation right now to drop the limits in the type of investor that can participate, the type of foreign investor that can participate in the market. But the cap of majority ownership, that's only going to be looked into next year.
And when you say the type of foreign investor, what specifically do you mean in terms of institutional retail?
So right now there's some limits on what type of foreign investor. So you have to have certain assets under management. And so they're looking, there's a consultation right now. They're going to look at how they can lift these restrictions. So that's also really positive, and people have liked this idea. But the fact that they've pushed the majority cap into next year. And they haven't really told us if they're going to do it. They just said they're going to review it.
Okay, so they've started the process of reviewing it, but an announcement probably is not going to come until 2026. A very important development there, could be quite consequential for the Tadawul, as Laura was just saying, one of the underperforming emerging market indices this year. Okay, speaking of indices, let's take a look at how global markets are faring into the final trading day of the week. It's been quite the week. So much going on this week in terms of those big geopolitical developments, the Xi-Trump summit. You had a lot of tech earnings come through this week as well. After hours yesterday, we had Apple and Amazon, and the reaction has been pretty positive, hence why you're seeing NASDAQ futures up 1.2% right now. So really reacting to the positive sentiment around those two stocks. Compare that to the reaction that we had in Meta yesterday during the trading day. Investors perhaps a little bit spooked out by some of their CapEx spending plans. But for the week, though, I should say, looking back, it has been a week of positivity for these U.S. indices. The NASDAQ is up 2.8% on a 5-day basis. So, yes, we had a bit of a pullback yesterday, but still tracking very positive. And let's not forget, we also had that Fed meeting as well. They basically said that December is not a done deal. So they cut 25 basis points and signaled that the path ahead for future interest rate cuts is not guaranteed. That also, as you can see in the front end of the U.S. yield curve, we've seen a big repricing with the 2-year yield now sitting at 3.6 and expectations for the December meeting, 70% of a rate cut priced in, only about 17 basis points. So a retracement coming through there. 10-year yields back at 4.10, though. Interesting dynamics going on there because we did see a big sell-off yesterday throughout the course of the day, even though we saw equities selling off. So interesting price action going on in U.S. yields. And then, of course, we're going to continue to keep an eye on how these trade deal, the implementation of this truce between China and U.S. is going to play out over the next year. They say it is a 1-year truce, but it is a big one for markets and market sentiment. All right, coming up in the next hour of Horizons Middle East and Africa, Deepak Mehra, chief economist at the Commercial Bank of Dubai, joins us to discuss his outlook after that Fed meeting. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. NASDAQ 100 futures on a tear as strong earnings from Amazon and Apple lift sentiment after a brief pause in the global stock rally. Oil heading towards its third monthly drop on concerns of a global supply glut as OPEC Plus plans to hike output again this weekend. Plus, Chinese President Xi Jinping warns against breaking supply chains in his first public remarks after the pivotal meeting with his U.S. counterpart, Donald Trump. Well, it's just gone 9 a.m. across the Emirates. I'm Jumana Versace, back in Dubai after 4 days in Saudi Arabia. Let's get you up to speed on how these markets are faring. And there is green on the screen today. S&P up around 0.2%. The NASDAQ up 1.2%. Real reaction there to Amazon and Apple earnings that came through in after hours. Contrast to the price action that we had in Meta yesterday. Some deep losses on that stock. Investors a bit spooked out by their CapEx spending plans. But this morning, things are back in the green again. And, of course, as we head into the weekend, a lot of focus on the OPEC Plus decision. We will be talking about that in a moment. But just shy of $65 is where Brent is, heading for its third monthly loss in a row. So downward pressure persists on the energy complex as people talk about the upcoming potential supply gluts. And then euro back at 115.72, trading at a 115 handle. We haven't been at these levels since about July of this year. ECB meeting yesterday, no fireworks. But the backdrop to that was the Fed meeting the day before, slightly more hawkish Fed, giving an uplift to the USD, downward pressure on the euro. Switching over, this is our global uncertainty index by Bloomberg, which is quite interesting because it tells you that investors have become increasingly immune to some of the shocks, the headlines coming through about tariffs, about trade policy. In the past couple of weeks, we've seen a little bit of a spike. You can see that little jump at the end into the Trump-Xi summit. But essentially, we're back to where we were in January of this year and tells you a lot about what is going to be driving sentiment in markets. And for now, what you're seeing is investors seem to be brushing off some of those concerns around trades. So very interesting development there. Okay, let's also check in on how markets in Asia are faring with Winnie Su in Hong Kong. Winnie, a bit of a pullback in Chinese stocks today.
Yeah, exactly. So before we go into and talk about the kind of the pullback in the Chinese stock, I just want to, shift your attention to looking at how the broader Asian market has been doing, because like you mentioned, actually it is losing a bit of a momentum that we had earlier in the morning when we had this U.S. tech optimism pushing the gauge higher. Now, still, we see that the Nikkei 225, the Japanese blue chip gauge, is still up slightly less than 2%. So boosting the overall Asia stocks higher. And that's really on the back of the earnings optimism domestically, but also with the U.S. tech names, like you mentioned, Amazon and Apple. Now, here, the Japanese yen is slightly strengthening a little bit, but still around that 154 level against the dollar. Remember, the yen actually weakened to a 8-month low yesterday after the Bank of Japan kept its rate steady. Now, we flip the board and take a look at the Chinese markets, because they are the worst performers here in Asia today. So across the major benchmarks, we are seeing that they are all in the red. And it is a bit of a cautious tone here. Yes, we did have quite a positive meeting between President Trump and Xi yesterday, but investors are still a little uncertain when it comes to how long this trade truce can be, and if there's going to be more details to come in terms of these deals. Now, we actually also have some earnings disappointment from the BYD, and also domestically we heard that there was a bit of a weakness when it comes to the factory activity. So still seeing signs of a weakness in the economy. So overall, a bit of a cautious tone when it comes to Chinese market.
Winnie, thank you so much for running us through it. Winnie Su in Hong Kong. Oil is heading for a third monthly loss on concerns of a global glut. That's as OPEC Plus is expected to back a further output hike when the alliance meets this weekend. For more, we're joined by Anthony DePaula, Bloomberg's Middle East energy markets reporter. Let's just start with expectations for this weekend and what we can expect.
Yeah, good morning, Jumana. Yeah, you mentioned that glut has got some traders and investors spooked, which I suppose is fitting for Halloween. So happy Halloween. But those concerns, I think, are going to be going beyond the weekend, of course, as there's that kind of structural focus that we're going to be weakening going into the next year. Of course, the OPEC Plus countries seem to be taking a different view. They're not concerned about a glut. We heard from the Aramco CEO earlier this week in Saudi saying that they didn't see a glut. They're looking at demand in China coming. China has continued buying. So that's probably feeding into some of these ideas behind OPEC Plus, that they will probably go into the weekend adding a bit more production.
Yeah.
We're looking at a smallish cut, somewhere a little bit more of 100,000 barrels a day on paper, because, of course, not a lot of those OPEC Plus countries have that spare capacity to add. So we might see an actual number of barrels coming into the market a little bit less than that.
Yeah, so, I mean, mainly the heavy lifting is coming through from Saudi and the UAE. But let me ask you this, with geopolitics in focus, with the U.S. administration's latest sanctions on those two Russian oil companies, do you think OPEC Plus might be sensing an opportunity to gain even more market share out of India and potentially China, even though we know that President Trump and President Xi didn't discuss oil in their meeting? But could there be an opportunity there to provide more supply, given Russia, there's a big question mark?
Yeah, so much geopolitics involved in this, because, of course, you've got the Saudi Crown Prince set to go to the United States in November. So Donald Trump has been pushing for lower prices. He is pushing for those sanctions, trying to deprive Russia of oil wealth, but he doesn't want a higher price. He wants those lower prices. So that's going to help the Saudis if they can go in showing, look, we're on your side, we're increasing production. At the same time, let's not forget that Russia is a member of OPEC Plus. So the Saudis are kind of in that area where they want to be helping one ally but not hurting the other. So they've got to kind of tread that fine line. We do see oil coming out largely out of India, as some of those producers, or some of those consumers, hold back on Russian purchases and look for alternatives. China's the big question mark. Is that going to be enforced? Of course, there's a lot of discussion around how strongly those sanctions will be enforced, but of course that's only one side of it. If the buyers don't buy, then you don't need to enforce. But what it looks like now in the market is that some of the Chinese buyers will continue taking some of those Russian barrels, while the Indians will largely back out, at least from those sanctioned barrels from Rosneft and Lukoil.
So interesting. Anthony, thank you so much. That was Bloomberg's Middle East energy markets reporter, Anthony Tapaula. Well, Apple is predicting a major sales surge during the holiday season off the back of its latest iPhones, helping assure investors that its hold on consumers remains strong. Bloomberg's Ed Ludlow has more.
In the holiday quarter, Apple said revenue growth would be between 10% and 12%, but that sets the iPhone maker up for its best ever quarter. And the acceleration largely attributable to iPhone 17 generation. You have to remember that in the quarter they just reported, there's only about 8 days of real sales data because the iPhone 17 went on sale September 19th. The quarter ended September 27th. Greater China was a really interesting one. It was a pretty significant miss in the quarter gone, but the way that Tim Cook explained it was supply constraints. They did not have the supply to meet demand in that market. Note that the iPhone 17 Air wasn't available in Greater China because of regulatory restriction on eSIM. But they do expect in the fiscal first quarter, Greater China to return to growth simply on the strength of iPhone 17. They said it's had a great reception there. And then other than that, the forward-looking stuff was a commitment to invest in AI, but that's largely in the form of OPEC reflected through R&D, not some massive capital expenditure commitment. And then there's the impact of tariffs. They do see it rising from an impact of about $1.1 billion to $1.4 billion in the period. But executives seem very comfortable with that. They seem to have a good understanding of the level of tariff, particularly as it relates to China. Overall, though, a lot of momentum, and it was all about this latest generation of iPhone. They talked a very strong game with also some emphasis on the services business. This is Ed Ludlow for Bloomberg News in San Francisco.
Amazon shares soared in late trade after its cloud unit posted the strongest growth rate in almost 3 years. Third quarter revenue jumped 20% on year to $33 billion. Investor expectations for the cloud business were relatively low after the company had warned of constraints in getting new data centers online.
AWS is gaining momentum. Customers want to be running their core and AI workloads in AWS given its stronger functionality, security, and operational performance. And the scale I see in front of us gives me significant confidence in what lies ahead.
And in other stories, Meta has sold $30 billion of corporate bonds after receiving record orders for the debt. The sale is the biggest high-grade offering of its kind since 2023. It comes after CEO Mark Zuckerberg warned Meta will spend even more aggressively on AI in the coming year, sending shares tumbling 11% in New York. Netflix is reportedly actively exploring a bid for Warner Brothers Discovery's studio and streaming business. Reuters cites anonymous sources saying Netflix has hired Moelis to evaluate a prospective offer and gained access to financial details. Bloomberg has been told that Warner's CEO David Zaslav has informed employees this week that the board would need a higher bid to justify a sale of the company. Still ahead, we'll discuss how Fed Chair Jerome Powell shocked markets with his comments on an expected December rate cut or not a rate cut with Deepak Mehra, Chief Economist at Commercial Bank of Dubai. That's next. This is Bloomberg.
First of all, I just say, and I think it's a point that's worth emphasizing, central bank independence, not just here in the United States, but around the world, I think it's served us very, very well. And I think it's something that we should speak out for, we should strive for, and I think it's important.
Goldman Sachs CEO David Solomon there. Well, joining us now is Deepak Mehra, Commercial Bank of Dubai Chief Economist. So many things have happened this week. Let's start with the Fed, though, because that sent a bit of a jolt to markets. I think people were not anticipating to sound not as hawkish, but as cautious as he did on Wednesday. Do you think it was justified?
I think his move was justified. The markets had gone a little too further, expecting almost 125 basis points of rate cut at one point in time till December 2026. So I think that was just not warranted, given inflation is still at 3%, and the underlying factors seem to be structural. I don't think monetary policy can fix this because you have very strong wealth effect in the U.S., which is keeping the consumers, the top 50% of the consumers, quite independent of where the interest rates are. They just continue to spend because of the positive wealth effect.
Yeah. So what is your outlook then for the Fed and the upcoming easing cycle?
So my outlook is that at best we get 2 more rate cuts, and then the Fed stops at 3.5% and then watches what really happens. Exactly the way they did it in 2024, 100 basis points of rate cut, wait and see what happens.
Yeah.
That will be the policy. And I think they are going to be very careful after that, irrespective of what the constitution of the Fed is.
Well, that was going to be my next question. Spring of next year, Powell's term comes to an end. He will be substituted most likely with a more dovish Fed chair. What does that do to the anticipated Fed easing cycle in 2026?
So look at Chris Waller and Michelle Bowman. They did not dissent this time at all. So I think even if the Fed constitution changes completely, the members of the Fed will be very conscious about the responsibility they carry. So I don't see that changing too much.
Even if you've got the president watching over your shoulder, messaging?
Because if they do that, the bond vigilantes come back.
Yeah.
And they punish treasuries.
Yeah.
And that would not be something that the administration would want at that stage. So I think there's a very fine balancing act to how much they can push the Fed.
Yeah. Okay, so let's just take it back to this week then. A slightly more hawkish Fed, not that much of a reaction in stock markets. I mean, yesterday we pulled back because of Meta, not because of the Fed, probably. And we're back again this morning with Apple and Amazon. So where does it show up then? Is it a dollar trade then, if you expect the Fed to be less dovish next year? Do you buy the USD?
So I think equities are immune because 40% of equity market is mega caps. They don't really care about where the interest rates are. The interest rate sensitive sector of the equities do not represent enough within the markets. So I think the big play comes in the dollar. Dollar has already run the course, which we've been saying for a while, 10% down for the year. And then from June onwards, it has been flatlined. So I think the worst is behind us. The trade that euro and the others were rising didn't really make sense, given that there is pressure on the growth outlook for the other economies. Whereas U.S. growth, even though it will slow down, will probably be better than the Eurozone and other major economies.
Okay, so play for a recovery of sorts with the USD.
Yes.
And I was looking at the euro this morning. We're back to a 115 handle, which also tells you about positioning. I know many people were playing for a stronger euro. What do you think that does to gold?
Oh, so the gold has nothing to do with these interest rates. It's on its own trajectory.
But the dollar?
Irrespective. It has been quite uncorrelated to the dollar this year. And it has moved up very significantly. So I think that is driven more by central bank buying, which probably comes in even stronger with this 10% correction that we saw. I think PBOC is building its stock from 6% exposure to dollar to something like 20%, which is the global average. Every other emerging market central banks are buying. Maybe the US is also buying gold.
So almost its own secular trade then going on in gold?
Absolutely, on its own.
Okay, so what do you think then is the biggest risk to the sort of positive risk on outlook that you've described, at least for equities?
So I think the biggest risk is that the Fed makes a mistake of going along cutting rates, and then that stokes inflation once again. We are at 3%, which is probably the new 2% for the Fed, which is acceptable, that they said in the summary of economic projections. But the way the consumer continues to spend, and if the labor market picks up as uncertainty on the tariffs and reduces, then the Fed will be in a very tough position where they could commit a mistake by cutting rates further.
Okay, it sounds like you don't really see this K-shaped economy that people have been talking about, where the upper earners are doing quite well, but lower income struggling because they're struggling to keep their wages are struggling to keep up with inflation, and they're faced with the prospect of a weakening job market as well.
You are absolutely right. This is the K-shaped economy, but the fact is that the lower bottom 50% of the population contributes to hardly 15% of consumption. So it really doesn't matter. Yes, they are loaded up with loans and the loan delinquencies are rising, but the top 50% own 98% of assets, which are rising. And they contribute to about 85% of all consumption in the US. So yes, there is a K-shaped, but the upper K is much stronger.
Yeah, Wall Street, Main Street. Deepak, always good to chat to you. Thank you so much. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Thank you. And coming up, how Middle East oil giants are using petrodollars to fuel the AI revolution. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Oil giants in the Middle East are using the region's oldest resource to finance a multi-billion-dollar bet on a new one, artificial intelligence. Saudi Arabia's Aramco and the UAE's ADNOC are stepping up cooperation with national AI champions as the global race ramps up. Bloomberg's Ahmad Shmouri is here. Ahmad, I've got to say, I've been in a very privileged position where I've actually visited the Aramco headquarters. I visited ADNOC. And one of the things that stood out to me is just how much both of those companies have invested in AI. Aramco have this industrial LLM model called MetaBrain. ADNOC have a digital command center called Panorama. So they've really invested a lot in artificial intelligence. But what's interesting now is they're also seeing an opportunity to perhaps use some of that expertise and channel it into these AI champions.
Absolutely. So this week's deal between Aramco and Hmeimim is a case in point. Their digital unit was seen as a success, and this is why the CEO of Aramco's digital unit was chosen to lead Hmeimim. So that was a testament to the work that they've been doing, and it shows that they can get things done. So in Saudi Arabia's AI ecosystem, Aramco Digital was seen as a bright spot, and Hmeimim's formation took much of that leadership and moved it to Hmeimim's side.
Yeah. So why is it, do you think, that so many of these GCC nations are actually leaning on the oil giants to help with the development of these AI national champions, as I was just describing?
Right. So that was one reason, that they get things done, and they've got a proven track record in the case of Aramco Digital. But also, AI requires immense resources in terms of energy and money, both of which that these state oil giants have no shortage of. And they can also provide the ability to take huge bets on these nascent technologies and provide the necessary financial padding if these don't work out.
Yeah. And in terms of the direct stakes, some people would say, why are these energy giants taking direct stakes? You've got Aramco with Hmeimim, as you were just describing. Then you've got ADNOC with AIQ as well.
Right. So one reason is that they expect to be key beneficiaries of these new technologies. So we're already hearing that they're cutting costs through these AI applications. In the case of AIQ, they're using ADNOC's data for the last 50 years and applying it across oil fields and cost-cutting. Aramco's CEO said this week that they're saving billions of dollars from the adoption of AI. Yeah. So that's one reason for the direct involvement, that they see a benefit to their business as well.
Yeah. I guess one of the other advantages is the sheer amount of data that these energy giants are sitting on as well. I remember at one point when I was speaking to Aramco, they were saying something like they get, a trillion parameters a day for their LLM model. So that's also very powerful because your output is only as strong as your input and the data that you have.
Yeah, absolutely. And it's also a way for them to adapt. Aramco's CEO told you earlier this year that they see themselves as a technology company primarily. So that's a way for them to think of a potentially post-oil future. And we can't isolate them from their own states, which are now undergoing immense and huge economic diversification drives that are enabled by the oil giants.
Yeah, one of Aramco's partners is Grok. I spoke to the CEO this week, and he was saying that he thinks Hmeimim is to AI what Aramco is to energy. So, yeah, very interesting perspective there. Thank you for bringing us that story, Ahmad Al-Shmouri. Okay, let's take a look at equity markets as we head into the final trading day of the week. We have U.S. equity futures leaning towards the green now. NASDAQ up 1.2%, so a positive momentum coming through from Apple and Amazon and after hours. This after pullback yesterday. European markets down about 0.1%, not really doing that much. Well, coming up, an Islamist insurgency that froze Total's $24.5 billion gas project in Mozambique 4 years ago is intensifying. More details next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Nasdaq 100 futures on a tear as strong earnings from Amazon and Apple lift sentiment after a brief pause in the global stock rally. Oil heading towards its third monthly drop on concerns of a global supply glut as OPEC Plus plans to hike output again this weekend. Plus, Chinese President Xi Jinping warns against breaking supply chains in his first public remarks after the pivotal meeting with his U.S. counterpart, Donald Trump. It's just gone 9:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. A bit of a pullback yesterday for Wall Street. Nasdaq down more than 1.5%, but that has been flipped around this morning. Futures up 1.1% in reaction to the strong results coming through from Apple and Amazon. It's been a big week for earnings this week. Some of those big, magnificent seven names reporting, and a mixed bag in terms of response. You had Meta, very underwhelming response by the investor community. Yesterday, the stock was down 11%, but then you had positive reaction for Apple, Amazon, and also Alphabet as well. So today, things are leaning towards the green. Brent sitting just shy of $65 here, 64.5, down 0.7%. Attention and focus will be turning to the OPEC Plus decision this weekend. They are likely to put back a little bit more supply to the market, something close to around 137,000 barrels a day. But of course, they have put back a full cumulative 2.2 million barrels, even more, over the course of this year. And there are concerns in the analyst community that the world is going to be faced with a huge supply glut. So we'll see how all of this transpires over the next couple of months. And then euro sitting at 115.70. We had the ECB meeting yesterday. No fireworks there, but the dollar has been recovering. Switching over, the chart that I've been talking about this morning has been the Global Trade Uncertainty Index. We have declined from, of course, back in April when President Trump made his initial tariff announcement. We shot up all the way to double digits. And now we are sitting back to basically the lows of the year, or very close to where we were back in January, and tells you that markets seem to be becoming increasingly immune to some of those tariff headlines and trade headlines that are coming through. Let's move on, though, and check in on how markets in Asia are faring with Winnie Su in Hong Kong. Winnie.
Morning, Jumana. So it seems like Asian stocks losing a bit of a momentum here. Obviously, we had a really busy and volatile week with earnings, with Trump's visit. So a bit of kind of digesting these new catalysts and new information out there. But here we can see that leading the gains here in the region are the Japanese stocks, specifically the Nikkei 225, up slightly less than 2%. And it's driven by the earnings optimism domestically and also U.S. with Apple and Amazon that you just mentioned. The yen here strengthening just slightly, but still around that 154 level against the dollar. And remember, that weakness overnight came after the Bank of Japan decided to keep its rate steady. Now we flip the board and take a look at what's going on in the Chinese markets, because that's been driving the region's weakness here, with the major indexes here all in the red. And yes, we did have that positive tone out of the meeting between Trump and Xi, but still investors are saying that they are a bit uncertain when it comes to how far this trade truce can last, and still finding the details a little bit underwhelming at this point. Earnings-wise, we see a bit of a disappointment when it comes to BYD's earnings, and hence a bit of a downside here. And also domestically, we got that weak factory activity data, which is also still pointing to the weakness in the economy, and hence a bit of a cautious tone here in the Chinese markets. Back to you, Jumana.
Winnie, thank you so much. Winnie Su in Hong Kong. Now, switching to the region, tens of thousands of ultra-Orthodox Israelis have held a mass rally in Jerusalem to protest against attempts to end their exemption from military service. Israel's Supreme Court ordered the conscription of the Haredim back in mid-2024 at the height of the war against Hamas, arguing it's a matter of equal protection and national security. Let's go to Jerusalem now and speak to Bloomberg's Dan Williams. Dan, beyond obviously the images that we were just showing now of those demonstrations, how much of a threat does this actually constitute to Netanyahu's government?
I think the point of this rally was to remind Netanyahu that the Haredim are a formidable force demographically and in the democracy. They called this a million-man march. That was slightly overblown. We're talking about many tens of thousands, but certainly sufficient to shut down much of Jerusalem for the day, to cause some friction between protesters and police, protesters and residents, protesters and members of the media. Now, they didn't really come with articulated demands. The point was to show how many they are and how many people they could muster behind the idea that they should continue to be exempted from conscription. That is an arrangement dating back decades when they were a far smaller section of Israeli society. Now the Haredim make up some 13 to 15%, given that they generally tend to have large families. That's put a strain on the economy. It's also put a strain on the military, certainly during this war in Gaza, when the IDF, the Israeli military, has suffered casualties on a level not seen in decades. So while they have numbers which give them a lot of clout and will make the government, this government certainly, because it's a right-wing government that has leaned on their support traditionally, think twice about any serious review of those exemptions from the draft, their numbers are also a source of rancor elsewhere in Israeli society among those sectors who do have to bear up, who do have to serve, who are not awarded those exemptions. So this is a running story. It's a story essentially that straddles the Gaza war, currently in a ceasefire, not officially over yet. Certainly, Israel expects further conflict in the future, and domestic politics. This is a very sensitive issue, and it came to something of a head yesterday with this rally in Jerusalem.
Yeah, and of course, just in reference to that ceasefire, it's still holding up, but very, very delicate after a couple of days of intense resumed airstrikes. Bloomberg's Dan Williams in Jerusalem. Thank you.
Thank you.
Now, Islamist insurgency that froze Total Energy's $24.5 billion gas project in Mozambique 4 years ago is intensifying. And just as the French energy major prepares to restart development, Bloomberg's Matthew Hill joins us live from Cape Town. First of all, just give us a little bit of context around these protests and the impact that it has had on Total's gas project. How did we get here?
Hi, Jumana. So this insurgency started in 2017. The group attacked a small town nearby the gas project and later pledged allegiance to Islamic State or ISIS and has been carrying out attacks across the northeastern province of Cabo Delgado ever since. That really the war reached a turning point in 2021 when they attacked the village of Palma, which is neighboring to the LNG, the liquefied natural gas project site. And that prompted Total Energies to declare force majeure on the project. And that's basically a legal get-out clause when there are circumstances beyond its control. And that force majeure has endured ever since until Total declared at the weekend that it intended to lift it and resume the project.
Yeah, what does a project like this, of this size, of this magnitude, mean for a country like Mozambique?
That's an important point. Mozambique has been putting pressure on Total Energies to lift the force majeure and resume work because it's quite desperate to tap into the revenues that this project promises to bring to the government. I mean, the government has previously spoken of nearly $50 billion in revenues over the 30-year project life coming to the state. And this is in a country whose GDP, the total annual production of the country last year was only $22 billion. So it's of massive significance, and that's why the government is quite eager to get this project moving along.
Yeah. At the same time, I just wonder the timing of this announcement from Total Energies, given that the groups have reported intensified violence, not just in the past couple of days, but in recent months. Is it actually safe for the projects this project in particular to proceed?
Exactly. Most of the analysts that we've spoken to for our reporting have pointed out that the attacks this year have actually reached a record level, an unprecedented level in this war. So there are a lot of questions around the timing of Total Energies' return. Some of the analysts mention that though there have been a record number of attacks, they are smaller, they're not very sophisticated, and the level of protection around the LNG facility that Total Energies and its partners have installed mean that a direct attack on the facility is not necessarily likely. But another important point is that Total has spent a lot of money on fortifying the project site over the past few years and have asked the government to accept an increase of $4.5 billion in the project. And they say even with that increase, the total capital cost does remain $20.5 billion.
Wow. Okay. Bloomberg's Matthew Hill in Cape Town. Thank you for bringing us that story. Well, for more stories like this from the continent, be sure to subscribe to the Next Africa newsletter on the terminal and our website. You can now also get the latest news from the continent on our weekly podcast, available on Apple, Spotify, and wherever you get your podcasts. And coming up, Russia resumes military flights to its airbase in Syria as the two countries work to rebuild relations following the toppling of Bashar al-Assad. More on this next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersetchi in Dubai. Russia has resumed military flights to its Hmeimim airbase in Syria after an almost 6-month hiatus. This as the two countries work to rebuild relations following the toppling of Moscow's ally Bashar al-Assad. The move comes 2 weeks after Syria's president, Ahmed al-Shara, met with Russia's Vladimir Putin. Joining me now is Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Stuart, so a couple of things here. At the time of the toppling of the Assad regime, there were lots of questions going around about whether Russia were going to continue to maintain their military presence in Syria and also whether they had the bandwidth, given they're obviously still engaged in a war in Ukraine. There's been notable change or developments in terms of President Shara flying to meet with President Putin. What is going on here, and what do you make of this recent rapprochement?
So I think that looking at it on two sides. So from the Russian side, this was essential to them. It was their only foothold in the Middle East. It was their only naval. I'm also talking about the naval base, but it's their only naval base on the Mediterranean. And they are very, very active in West and Central Africa. If you don't have Syria as kind of a stopover point, it makes logistics very, very difficult. Not impossible, but very, very difficult. From the Syrian side, I mean, he needs as many allies as he can get. And that's everything from money for reconstruction to potentially some sort of military cooperation in terms of fighting Islamic State in the east. And you've seen little bits and pieces. So, for instance, back in February, they flew in a bunch of Syrian banknotes from Russia, new banknotes, because there was a shortage of cash. So it might be those sort of things that they're working on.
But what about the geopolitics of this all? We know that the U.S. administration, President Trump himself, has thrown a lot of weight behind the new president. He's met with him personally. Does he not risk angering President Trump by cozying up to President Putin?
Yeah, potentially. I mean, that's definitely an issue there, but it depends how it manifests itself. So at the moment, what we've seen on the flight tracking is air transport coming in and then heading back to Moscow, or heading on to Moscow, I should say. So it depends what it looks like. And from what we can understand from the reporting we have, it's going to be a much diminished presence. So at the time of Bashar al-Assad, it was a really, really hefty presence they had in Syria. That's been pared back very significantly. So we'll look over the next few months to see just to what extent Syria allows them to reoperate.
Okay, so you talked us through the significance of having this airbase, this military position in Syria for Russia. Why is it important for Syria to allow the Russians to keep access to the base? What are they getting out of this, essentially?
I mean, it depends what they get in return. And our assumption is there will be a certain degree of funding towards reconstruction. There'll be military aid, presumably of some sort, because you remember in the months after, and I think it continues to this day, the months after Bashar al-Assad fell, Israel pretty much wiped out all of the military capability, or a significant proportion of it. And so that is Shara, is faced with a very fragmented country. He needs to establish his control, particularly in areas in the east and elsewhere. And he needs military help to do it. And he doesn't necessarily have the funds to go out and buy a lot of military equipment to equip an army.
Yeah. Interesting. Stuart, thank you so much. Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Now for a look at some of the other stories we're following today. Oil giant Shell has beaten estimates on profits and maintained share buybacks while paying down debt, showing its resilience to weaker oil prices. The third quarter performance was helped by stronger oil and gas trading, a vital part of the business that struggled earlier in the year amid geopolitical volatility. Nissan has warned it expects a $1.8 billion operating loss this year as it pushes ahead with a cost-cutting turnaround plan. The outlook is the Japanese carmaker's first for the fiscal year ending next March after previously withholding guidance. While Nissan did trim its loss estimate for the second quarter, Bloomberg Intelligence says this is due more to one-time costs. And BYD posted a 33% slump in profits as the Chinese EV giant struggles with cutthroat domestic competition impacting its sales outlook. Overall revenue fell, missing analyst estimates. Shrinking gross margins highlight the pressure from a prolonged price war. BYD's stalling sales saw it lose its title as China's best-selling automaker in September. And Tesla shares fell after its 10th recall of Cybertrucks in less than 2 years. The latest affects over 6,000 units of the electric pickup. It stems from a potential issue with an off-road light bar accessory, which could detach and increase the risk of a collision. The EV giant says it is not aware of any crashes, injuries, or deaths related to the issue. And coming up, Tanzanian authorities have lifted an internet blackout imposed after a controversial general election. More next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Tanzanian authorities have lifted an internet blackout that was imposed to try and quell riots which broke out after presidential and parliamentary elections. President Samia Suluhu Hassan is seeking a second term in the election and is almost guaranteed to win because her main opponent was barred from running. Our chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. Jen, what is the latest?
Yeah, Jumana, it's been quite an evolving situation since those elections on Wednesday. As you were just mentioning there, we have seen outbreaks of violence being reported. There's clashes between protesters and police. And of course, we did see an internet blackout initially. That's been lifted, but a curfew has not. And I was just taking a look at a U.S. Embassy advisory, and there's still reports to be the closed down streets to the official international airport there in Dar es Salaam. But we should remember these pictures that a lot of the frustration has not just been this week. There had been weeks and months of frustration by a number of Tanzanians just calling for free and fair elections because the ruling party, as you were mentioning there, President Hassan is now the official leader of the ruling party, but they've been in power for more than 4 decades. And so a number of Tanzanians were calling for free and fair elections, especially after we did see the main opposition candidates barred from running, and in some cases even detained. So much so that Amnesty International actually was reporting that leading up to the vote, there was allegedly silencing, the authorities were silencing dissent and committing systemic human rights abuses. We should point out, though, that the government, when they did see that official report from Amnesty International, they said they were deeply concerned by it and that the government was committed to the protection of human rights, freedom of expression, peaceful assembly, and access to information. But many people are wondering just how that's playing out, especially now that we're seeing some of these pictures and getting some of the reporting there on the ground in the economic hub of Dar es Salaam.
Yeah, I mean, you speak about Dar es Salaam being an economic hub. Do we know, is it too early to say what some of the financial implications are of this continued unrest?
Well, we have seen some multinationals already taking some steps, given the reports that are coming out there. One, Emirates has a flight from Dubai, actually to Dar. They put out an advisory that I was just taking a look at. It's still in effect. And it's not just tourism that we should point out there. Of course, Tanzania is home to Mount Kilimanjaro, Zanzibar, which are two very big tourist spots for people. But it's also very important for a number of copper producers. And I'm talking about Zambia and the DRC. There in Tanzania, there's a very critical port that copper producers rely on. And so if we do continue to see unrest, potentially we see more multinationals taking some steps. I know earlier you were just speaking with our colleague Matt Hill about Mozambique and the situation there. There's also concern because President Hassan was meant to oversee a $46 billion LNG project. And so what does that mean potentially for ongoing agreements that have been made? There's also a number of investments into ports and railways and harbors that are in the pipeline there in Tanzania. So you can only imagine that multinationals are watching the situation very closely and continuing to see how it evolves. And I should just point out, we haven't gotten official results, but you mentioned there, it's largely expected that the ruling party and President Hassan will be reelected.
Jennifer Zabazaja, our chief Africa correspondent in Johannesburg, thank you for recapping the latest in Tanzania. And a look at how some of these global markets are faring, coming off what has been quite an eventful week, not just for us in Saudi Arabia at FII, but for global markets more broadly. So many different things have happened. The big event in terms of geopolitics was that meeting that took place between President Xi and President Trump. You look at the market reaction yesterday, the pullback that we had for Wall Street, and perhaps investors were slightly underwhelmed with the content there, the framework, and the fact that this looks more like a truce as opposed to a more fundamental shakeup of the trading relationship between China and the U.S. So something to think about in the coming months. We also had the Fed this week. They surprised by perhaps announcing that a December cut was not necessarily a done deal, so a bit more hawkish comments coming through from the Fed. You can see that being reflected in the yield curve. We have 2-year yields sitting at 3.6 now, with only 17 basis points priced in for the December meeting at this point. And then 10-year yields, we've actually lost a lot of ground. We were trading sub 4%, now back to 4.10. So some selling came through in yesterday's trading. But again, also keeping a close eye on earnings. The earnings continue to come through in the U.S. It was a really big week for tech earnings. Yesterday, the big ones reporting were Amazon and Apple. Apple surprising the market to the upside with the sales of its iPhone 17. Amazon as well posting very strong results on their AWS, their cloud units, and they, of course, are the market leader. So both of those stocks have done extremely well in after-hours trading. We expect that to continue once the U.S. opens up, and that's why the markets, at least the NASDAQ, is leaning more positive today. Compare that to the price action yesterday with Meta, which was down 11%. And a programming note for you as we end the week. From Monday, Horizons will air at 9 a.m. Dubai time. That's 7 a.m. in Johannesburg and 1 p.m. in Hong Kong. And on Monday, we'll be live from ADIPEC in Abu Dhabi. This is Bloomberg.